This is your daily real estate syndication show. I'm your host, Whitney Sewell. Today, we've packed a number of shows together to give you some highlights. I know you're going to enjoy the show. Thank you for being with us today.
Devin, welcome back to the show. I've been looking forward to this interview. You and I haven't got to catch up in a couple of years, I think, but you've always been somebody I've respected in this space. And so I value your thoughts and I know the knowledge and things you're going to bring to us over a series here, just so the listeners know. We're going to do at least a couple shows with Devin and dive in on a number of topics that are going to be relevant to you today in your business. But Devin, welcome back.
Whitney, it's my pleasure. I'm glad to reunite here on the podcast, and I was happy to see this on the calendar today. So good to see you. Look forward to catching up.
Yeah, me as well. Devin, give us a little bit about your business right now. I know there's a couple of things you and I talked about. We're going to dive into, but give us an overview. What DJE, what y'all are up to at the moment. Maybe how things have changed a little bit over the last year, and let's dive in.
Yeah, I'd love to. So just kind of current snapshot of where the business is at. We own varying ownership stakes in about $250 million of real estate. All of that's in Texas. Most of that's in San Antonio. Most of that's multifamily. So, multifamily deal, I might have 30% ownership, 25% ownership, just kind of a general partner ownership. We usually syndicate that. And then we've got industrial projects. We've got rural land projects, which is kind of off the beaten path there, but has been good for our business. And then we've got the management company as well. So our company's about 75 strong right now. Most of that is on the multifamily property management team side. And then, here I'm sitting here in our corporate headquarters downtown San Antonio with kind of the accounting team, investor relations team, transaction coordinator, a brokerage that I'm a partner in, and a consulting company that I'm a partner in. So that's kind of our hub. And that's what the company looks like right now. We wanted to come out and buy 1,200 units as kind of our target for 2023. Just like to set that out there. Not that we have to. To date this year, we bought a little 114 unit. We took over a mixed use project, which is 60 units, and then we're closing 300 units this week, actually. So slower on the buy side than we wanted to, but we're still out there. We're not pencils down. We're constantly looking at deals. It's just a matter of, hey, debt's a lot different than it was before. So what are we doing? Are we assuming a loan? Are we getting high interest fixed debt and making it work? Are we, what are we doing there to still do multifamily deals? So we love multifamily. We're built for it. It's the majority of our portfolio, but we've got some other avenues, both for us with our operating overhead, that we need to meet those objectives. And then for investors too, we want to constantly have a menu item. It's no good to get somebody fired up about putting $50K in a multifamily deal and you don't have a deal for them at all for 12 months. That's not a great experience. So we found some other ways to kind of, I would say, have regular deals to put in front of investors, which I feel like helps keep us relevant, helps keep people's money moving, which is what a lot of folks want.
That's awesome. I appreciate you mentioning a few things there, because I was telling you this before we started recording. I know the listeners have heard me talk about this a little bit, is that obviously it's been a time where these multifamily deals we've been doing has kind of dried up a little bit, right? There's just not been the deal flow, or there's not been deals that we can get done, right? With debt as high as it is, or expensive, and interest rates. So I think there's been a few ways that you and many of us have had to be creative, right? And I think it's ways in times like this, it pushes us to be better, right? In so many ways. And I think we're going to dive into some of that. You mentioned closing a 300 unit deal, I think this week. Is that
That's
right?
Yeah.
Can you, since you mentioned that, I thought it would be helpful. Can you highlight that, or are you able to talk about that deal?
I don't have to disclose every last detail. It's actually two deals adjacent to each other, same ownership group. And it's a basis play. We're getting fixed rate debt with it that starts with an 8, that'll make your eyes cross, right? Especially when I'm looking at some of our fixed rate debt. We've got a deal we're taking to market with, most likely it'll be an assumption at 3.5 on the rate and 7 years left, right? Just like things changed a lot in the last 18 months here. So anyway, high rate, but really, really good basis, 20-year ownership, which I rarely see. and just kind of all the things you want, 100% occupancy, well below market rents, well located, all that kind of stuff. So it worked because of the basis, and the seller's basis is so low because they bought it in, the year 2001, that it's just like we're in a different universe. How much inflation's happened since then that, are they selling it for less than they could have 2 years ago? I'm sure. Do they care? They don't care because their basis is just, you don't even want to hear it because it's so, it's so low.
Yeah.
They're going to
Especially
do
being
just
the
fine.
buyer.
So, but our basis, it works great. It's a rebrand play. It's an operations play. It's a value add strategy play for us. And so that, that's one that, we moved quick on. We actually put hard money on it too. And that's how much conviction we had in the deal in a market where hard earnest money is just not really a thing. We just saw this one. And I'd mentioned that we're not really pencils down. We're always looking at deals.
Mhm.
Got an analyst and brokers helping us, looking at deals every week, making offers, want to transact. And, that's acquisitions you're going to swing and miss just about all the time. And so when you see one that makes sense, first thing you do is say, okay, what are we missing? Why are the numbers working? Did we, is a cell wrong in the model? Or first question, what's going on here? Why is this penciling? And then once you, get a bunch of eyes on it, you get your debt broker to look at it, you get the analyst and the operations team and everybody's kicking around, and you validate that, okay, no, we're looking at this the right way. We're excited about this. Let's put everything we got behind it, make sure we win this thing. So that was kind of the deal behind that. We put fixed rate bridge debt on it just because we want to be able to forecast our number. We've got some variable rate stuff and rate caps. And if anybody's been dealing with that the last year, it's been tricky to navigate with some of your debt service climbing, or if you have a rate cap maturity coming up, you got to figure that out. So we want to say, hey, we're gonna fix it. We've got 3 years plus one, so possible 5-year term. We kind of assumed we're going to be in the same high rate the whole time. But if we get an opportunity to refi or sell in a low rate environment, that'll be some bonus, but we're not counting on it. Again, just kind of a basis, good old fashioned value add play where we're going to go in and spend close to $4 million on rebrand and new office and parking lots and roofs and painting and interiors and kind of the whole 9 yards. So we're excited about that deal. Glad to have one to kind of get done here right at the beginning of Q4. Keeps the team busy.
Yeah.
Across the board, investor relations and the operations team. And, we want to be doing deals. It's been slower for us, like it's been for everybody. But I think the name of the game for us is it's always been hard. Like acquisitions for me, never been easy. In 10 years of doing it, never been easy.
How did you all find this deal?
Broker. I'm as a marketed deal.
Okay.
So, it was a deal that there's one broker that, for whatever reason, has been staying real busy in Austin and San Antonio. And we've known him for years and have good relationship. And he was able to give us a pretty strong recommendation to the seller.
That's awesome.
Yeah.
It's been interesting. The brokers that are still active at the moment, right, are the ones that are still calling what's happening. And because man, I know it's been slow for them, right? No doubt about it.
Sure.
Any other before we move on, I was just thinking about even this deal, or how much are you all raising for this?
11 million.
How would you gauge the raising ability now compared to 12 months ago or 18 months ago?
It's really interesting. We do a number of different types of deals, and there's some debt stuff, and we have a fund, but let's just talk good old fashioned multifamily syndication. We've always done them like a lot of folks do, just kind of on demand. Get the deal under contract, do some due diligence, get it to a point where you're going to close it, launch it, and raise the equity. And we've been at this for a number of years, so you always feel pretty good about, hey. But every time we launch a deal, it's like, hey, how, is this going to fill up overnight? Is this going to be a lot of phone calls? How's this going to go? I think, $11 million in this market was pretty straightforward for us. We raised it pretty quick, but I think that's a function of a couple of things. One is just kind of that snowball effect of adding investors over years and years. So the investor base has just grown a lot for us.
Mm-hmm.
Two, less deal flow in the last in the last year. We wanted to buy 5, 6 deals this year if we could find them. And I think we had the ability to do that. It's just we haven't found them. So less deal flow, more investors. And then I think just the story of the deal itself. Hey, is there interest rate risk on the table? No, we've locked that up. That's not really the issue. Yeah, we're paying a high rate, but the basis, we want on the buy side, we want low rates and low prices. Not going to happen at the same time, right? If we got low rates, we're going to pay high prices as buyers. Right now we have high rates. And so if you can find a low basis and make it work, then that's it. So to answer your question, I think for us specifically on this deal, it went well. It was very smooth, but that's because of limited deal flow this year for us and a growing investor base. So that was kind of it. Anecdotally, what I'm hearing from operators out there is that certainly it's more challenging than it's been.
What would you say is your, and I normally ask this towards the end, but I think it's helpful right here. What's your best source for meeting new investors, and you're all growing your investor base right now?
Right. I'm on a bunch of calls this week with some marketing firms. We've not ever paid for marketing or done anything, but I think it's time in our company's history to start exploring that, right? We've got the budget for it. We've got the team, got maybe the infrastructure to handle that. Historically, though, this company started with me doing houses with hard money. And then once I had a track record there, borrowing $100,000 from a guy I met at a meetup who was my first private lender. That was this big aha moment. And then, and he was easier to work with and a little lower cost capital. And I thought, man, I can do this all day long. If there's built, then there's 2 private lenders, then there's 5, then there's 10, then there's a syndication, which is different, but really started with one person and has kind of grown since then. We brought Justin on a couple years back. It's been about 3 years now since Justin joined. He's our head of investor relations, and to kind of take over that, talking to investors and the whole investor experience. Justin runs that, but it's still very organic. I've got a podcast, and I'll tell you, number one, just to get to the punchline, it's a referral. Absolutely. It's somebody's in a deal. We took care of them. Now their brother wants to take a look. And that's been it, which I think is great for any business, right? That's the best kind of way you can grow. So referral, it's been a long, slow growth path for us. But what we set up a few years ago was let's just focus on having a phone call or 2 a day per business day with a prospective new investor. And that's somebody that has the capability to invest. They know our minimum is 50,000 and they're interested. Okay, that's enough. Get in the system. We're going to have a call with them. We're going to send them a Starbucks gift card and an email, say thank you. We're going to put them on the newsletter list. We're going to let them know if deal launches. And as long as we're just doing that consistently, and how I knew I needed to hire somebody for investor relations is I set some goals, and that the week could go by, and I said, man, I had one investor prospect call this week. That's not going to cut it. It's time to hire somebody. But we've been doing that consistently for like 3 years now, and so just organically having those conversations, relationship referrals is how we've done it. And so, I will occasionally go speak. If I'm going to go speak somewhere, it's leveraged. I prefer to be in front of a lot of people to where that time is highly leveraged for me and making maximum impact. So I do some speaking and things like that. But at the end of the day, it's Justin just kind of day in, day out, having conversations with new folks, telling them about what we do, putting them on the list and letting them know when we've got a deal.
And they're coming, mentioned from referrals, but any other way that they're finding you though, to be able to have that call with them?
Yeah. So, I've got a podcast, and I think we don't have the best tracking mechanism in the world to be able to point to, they listened to episode 166.
Yeah, it's hard.
But we're out there with that. And then I'll go do speaking engagements. And again, it's really hard to kind of point to a path, for that to come in. But we get a lot of anecdotal feedback about the podcast and events. So I think, for somebody that's out there syndicating, set a target for yourself to have those lunch meetings, to have those coffee meetings, to have those 15-minute Zoom calls just to kind of get to know people. And I think you can always continue to have those conversations, even if you don't have a deal. Everybody wants to have a deal, obviously, but you can continue to do those exercises and go through that and build those relationships over time. Cause a month is going to go by, 3 months, 6 months, a year is going to go by quick. And if you are consistently having those conversations, that's going to build up over time. So,
but Devin, recently, you have, or I don't know how recent, you and I have talked about it, but you all pivoted into maybe some other asset classes. I know you and I both were very multifamily focused, right? And have been for a long time. But you all have gotten creative, right? And done a couple other things. I want to dive into that. And even the thought process of being able to pivot, right? And doing some other things that I feel like sometimes we can be so, have the blinders on, right? We're so focused and think this is the only route, this is the only path, doing multifamily deals the way we've been doing them the last however many years. And a lot of that's changed, right? The way we're doing deals now. So give us some of the ways that you all recently pivoted, and let's dive in on those.
yeah, sure. So it's interesting. It's, I would advise someone that's starting to have the blinders on, right?
Yeah.
I think in anything that you're trying to develop mastery in. So I think it's tempting when you're starting real estate investing. Oh my gosh, there's 1,000 things on the menu. And is this one better? And you're running around with shiny object syndrome. I think we're all susceptible to that early on. Where, our company is, or was a number of years ago, we kind of had already developed, wouldn't go so far as say mastery, but a high level of competency around buying these multifamily properties and all the things that entails, operations and the equity and all that stuff. But at some point, I'm running this company and saying we're putting a lot of eggs in the basket of being able to find another 200 unit deal. And, we don't ever want to be in a position to have to buy a deal for fees or whatever. So, what does that look like? And it just kind of worked out for us that I had met a broker in 2020 and bought a ranch in South Texas. And I don't know, it was almost, I was almost just compelled to do it. It was almost like a God thing. Like I just felt this overwhelming urge to buy this ranch. And I would even have these conversations with myself, like, what, this makes no sense. What am I doing here? I just feel like a field of dreams here. If you build it, they'll come. I have to buy this ranch. And I don't know what it was. It turned out to be one of the best things for family. It's me and my boys go out there and hunt. And in the beginning we camped and then we ended up putting a house on it. So really amazing experience, great place to get away, really rough terrain, all that. But through that and being very compelled to kind of buy that ranch personally for the family, developed a great relationship with that broker. And right after we bought our ranch, I said, hey, could we buy one of these and then sell it for a profit? If we bought 100 acres, well, not everybody wants to buy 100 acres. Somebody might want to buy 25 acres and they'll be willing to pay more per acre for smaller. And, we got a real salesman on board with our broker, and he's like, absolutely, let's do some deals. He's going to get to do both ends of the transaction. I'm a cash buyer. He's loving it. So we went out and did a couple little deals, 100 acres, 150 acres, 300 acre deals, prove the model out. And them couldn't be any simpler. If we're buying something at 5,000 an acre, buying 100 acres, we might sell 3 tracts at 8,000 an acre. And what you're doing is you're creating a smaller piece of land that has a different buyer pool. And we're not building houses on it. We're not getting plats and doing a bunch of improvements necessarily. Simply just taking it from one kind of buyer pool to another. Think about it like a wholesale retail. We're buying a lot of it. We're selling smaller pieces of it for a higher price. So that was it. And that was, it made money. And not only that, it was super fun. We got all these ranches, we got all these places to go hunt on, go camp on. That's a lot of fun. I love our brokers. He's become a friend. We, go on hunting trips and go play golf together. So like all the things you want in kind of a business relationship were there. And then, after having some success on our own account, took it to our investor relations and said, hey, do you think people would be interested in doing these land deals with us at, there's no bank involved. It's not equity. We'll just pay them 11% on their money and we'll be in and out in a year. And we started launching those to our investor base and they liked them. So now, we've done, just tens of millions of dollars of transactions of land now using that same model. And, they're not the type of deals where we're 10X in money or anything like that, but they're enough. I've done enough real estate deals over the years. There's meat on the bone. Everybody involved can win. The investors like it because it's debt and it's short term. It's not this long term. And then, we get to make a little money off them on quicker turns that, bottom line, to kind of bring it full circle, makes us less dependent on having to do a multifamily deal. Whole company's based around doing multifamily deals, but we can go do these land deals to supplement. And it does two things. It gives us deals for the company to keep churning away on deals, making some money. And then it gives us another menu item for investors. And I mean, I said on one of our other segments, Whitney, that, we'd like to buy a deal a quarter, 2 deals a quarter, multifamily. We're geared, we're ready to go for that kind of stuff.
Yeah, we
But
would too.
yeah, you can't find them. And
Yeah.
now you're looking at a deal a year or 2 deals a year. Man, that's a lot of dead time for those investors to just be reading your newsletter without anything to sink their teeth into. So now with the land stuff, we might have 8 land deals in a year. Now they're smaller, $1 million, $2, $3, $4 million, but it's something to get out there. And what we're hearing from investors is like, hey, yeah, we like you guys. We want to keep rolling the money. We're coming out of this. What do you got? And so just being able to be in front of people all the time with that debt offering has been really great for the firm. Really, really great for the firm and for the investors. It's just another menu item for them to look at. It's optionality. It's optionality for the investors. It's optionality for us. And compared to multifamily, it's been pretty minimal from like a management perspective.
I love that part of it too. It's probably, I would imagine, much less due diligence, right? As well. So it's just less required of your team to go to produce some transactions here that's producing some returns for your investors. You're right, and for you all. And so, can you speak to the structure of that a little bit? And because I was just thinking about, how you're getting investors involved in that now and how it's structured with them a little bit.
Yep. So we just set up a 506B debt offering, and we just had the attorney draw it up to say, hey, we're going to launch this company. We're going to raise, just like a multifamily syndication, we're going to sell shares in it, $1,000 a share, 50 share minimum, come in, and we're raising this much money. Here's our sources and uses. We're going to pay 10% while we're in it. So 10% annualized monthly distributions, 12 months out, exit. We got 1 point on the exit there. So, kind of a standard PPM like you would expect to see on a multifamily deal. Our attorney, we kind of reduced our costs a little bit just because it's rinse and repeat, same thing every time. So we're not into it for the cost that we'd be on like a full multifamily deal. Also, there's not all these lender negotiations. I mean, when you're hiring your syndication attorney on a $30 million apartment, a lot of that bang for the buck is, man, all the back and forth with lender counsel, right? I would not, you got to have the right person on the team to be running that. But on these land deals, like there's literally not a lender. There's not as much due diligence. It's just, hey, we're raising this bucket of cash. I'm usually in for, call it a 20% co-invest. If we're raising $1 million for a piece of dirt, I've got 200K in there. And then we're just going out and buying it cash and subdividing it and selling it.
Yeah. So you're not raising on a per deal basis. Obviously they're a lot smaller. So that would probably not be cost efficient to do that. But so you're raising a fund that's open all the time.
Well, we're both. We actually are raising per deal on the land stuff, and usually it's at least $1 million. And like I mentioned, it's kind of a rinse and repeat deal on the legal docs, so the cost is not it's not egregious there. But $1 million's kind of our threshold to say, hey, we even kind of have our systems internally. It's like, is this syndicated or not syndicated? If it's a land deal for 400K, I'm just going to buy that cash. If it reaches that 7-figure all-in mark, okay, we're probably going to throw that out to investors and maybe put, 5, 10, 15 folks on that deal with us. So we are doing that per project. It's a little, it's syndication, but it's so rinse and repeat for us that we kind of have it all dialed in. We've got our costs dialed in, and it works. And then we do have a fund, which is kind of a separate thing. But we've been doing these ranch deals, just kind of one-off syndications.
Okay, so you all will do a debt deal or a fund on each of these land transactions, but then you also have a debt fund that's just open all the time. Is that right?
Yeah, it's open all the time. And, I wanted to do this for years just to have some flexibility and have cash to be able to execute on some stuff. I just was never comfortable being on the clock, I guess, for it. In my mind, I wanted to have a fund where if you contribute to the fund, it's paying out. I didn't, and I know folks will do funds where they're subscribing it, but they're not calling capital. I don't want to be in a situation where you've committed 100,000 to me and I'm not going to tell you when I need it. And I'm going to come back 7 months later and go, all right, Whitney, we're ready for your money. And you go, well, shoot, man, I made other plans or life got in the way or whatever. So I like to get capital in and immediately start. It's on the clock for investors. So that means we need to kind of have a lot of deal flow. So what we were able to do is basically, 4 buckets of types of deals. We'll occasionally do some small one-off stuff. Maybe it's commercial, maybe it's single family, pretty rare, but just outright cash purchases, and then a value add and an exit, or a value add and a refinance to take the fund out. Land deals, where we're buying rural land that we're not syndicating, or we're buying land that we're going to develop. So we've been doing industrial contractor garage flex type projects, and we might be into a piece of dirt for $1 million, and there's 6 months that we've got to be in it and doing all our stuff with the civil engineer and with the city and getting all the boxes checked on all our pre-development work. That might be 6 months where you don't want the whole capital stack raised, but you do need 500 or $1 million to lock up the land and stay in it. And then we kind of capitalize it fully when we're ready to put shovels in the ground. So that was, industrial is another one. And then there's potential too, where we haven't deployed into this yet, but we expect to, where, hey, we're getting a low leverage loan at say 55%. We're going to bring some of that fund in to take it up to 65% so we can get a little bit better leverage and make a little better return for the equity in the deal. And in that respect, it's acting kind of as our own little pref equity bucket that can still produce, we're trying to put our fund out at 12%. So it's still a little bit better than we could get third party pref equity, and a lot less fees and headache and everything like that, still produce a yield. And so there was enough different asset types for us to put the fund into to say, yeah, let's go through the legal expense and everything of setting this up. And then so that's the benefit for us, is just more optionality to get into deals, and enough types of deals that we're doing in our backyard here in San Antonio to be able to deploy that. And then for investors, it solves the problem of, okay, you come in, you talk to us, sounds good, you're excited, you got 100 grand you want to put into a deal. Well, hopefully we find a deal, watch your email. It's a bad experience, right?
Yeah.
And then you do watch your email, and if it's a smaller deal, it fills up overnight and you missed it. And if you're a new investor with us, it's like, well, that wasn't a great experience. So now on every call, we could say, well, listen, we do multifamily, we do land stuff, but there's a debt fund right now if you want to try us out. Again, optionality, another menu item. So we've grown that right now. We're at about $8.5 million. We'd like to take that fund to 25 million. So not a huge fund. I talked to a equity provider yesterday, and they're like, yeah, we're raising a $200 million discretionary fund. We don't know what we're going to use it for, but we're going to start raising it now. We think there's going to be some deals. And I was like, well, okay. Yeah. That sounds good. So different strokes for different folks. So, but we've been around long enough. We've got enough types of deals to deploy it into that I feel comfortable being able to have it about 80% of the cash in that fund deployed at any given time to be able to kind of make the numbers work.
That's awesome. Because that would be my concern, right? Is like being able to get it deployed fast enough, because these investors are earning immediately.
Yep.
And obviously you don't want to do a bad deal, right? Or feel like, be pressured, right? But if you got enough deal flow that you can count on, obviously that's the key, right? But it sounds like, this could be used for a number of different asset classes potentially, right? For you all to be able to maintain getting it out, right? Out of your all's hands. For tomorrow's episode, how can they get in touch with you and learn more about you, Devin?
Yeah, thanks, Whitney. The best spot would be our website, djetexas.com. So that's Delta Juliet Echo Texas.com. And you can see some of the deals we're doing and podcasts and reach out and connect with us.
Thank you for being with us again today. I hope that you have learned a lot from the show. Don't forget to like and subscribe. I hope you're telling your friends about the Real Estate Syndication Show and how they can also build wealth in real estate. You can also go to lifebridgecapital.com and start investing today.